Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, February the 19th, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the energy markets are commanding attention this morning. Oil prices have hit their highest level since summer, with Brent crude pushing further above $70 per barrel. This is a 6-month high for the global benchmark, and it's being driven by escalating fears around a potential US-Iran conflict. That geopolitical tension is creating supply concerns that are rippling through energy sectors. On the retail front, we're seeing a mixed bag. Walmart reported strong holiday growth, but their earnings outlook fell short of Wall Street estimates, which is raising questions about consumer spending power heading into the back half of 2026. Meanwhile, Wayfair posted its first annual sales gain since 2020 and actually outperformed the overall furniture market, which suggests some selective strength in discretionary spending. In the corporate space, there's pressure building on certain names. First Service Corp and Trex are facing competitive headwinds, while AAON saw declines despite what were actually solid results. The market's being pretty unforgiving right now if you're not beating expectations by a comfortable margin.
That selectivity you're mentioning is really the story of this market. When you look at oil pushing higher and retail showing these mixed signals, what does this mean for traders trying to position themselves?
It's all about being tactical right now. The oil rally is benefiting energy stocks, obviously, but it's also a headwind for consumer discretionary and transportation sectors that are sensitive to fuel costs. For traders, the energy sector is showing momentum, but you need to watch those geopolitical headlines closely because this could reverse quickly if tensions ease. On the consumer side, the divergence between Walmart and Wayfair tells us that investors are rewarding companies that can show real growth, not just maintain market share. Walmart's guidance miss is concerning because they're supposed to be the bellwether for the American consumer. If they're seeing pressure, that could signal broader spending weakness ahead. The trading opportunity right now is in being selective within sectors rather than making broad sector bets. You want companies with pricing power and strong balance sheets because if we're entering a period where consumers are pulling back and input costs are rising with oil, margins are going to get squeezed for a lot of names.
That margin pressure is going to be a key theme to watch. Steve, let's get into the economic numbers. What's the picture looking like?
Thanks, Robert. Earlier this week, we got several important releases that are painting an interesting picture of the economy. Housing starts came in at 1.404 million on Tuesday, which actually beat the forecast of 1.33 million and was up from the previous 1.322 million. That's a positive signal for the housing sector showing some resilience. We also saw durable goods orders on Tuesday, which came in at 1.4%, missing the 2% forecast and down significantly from the previous 5.4%. That's a notable deceleration in manufacturing demand. Industrial production for January showed 2.3% growth, up from 1.3% previously. So we're seeing some strength in the manufacturing output side even as new orders are softening. Now looking at today's releases, we have initial jobless claims and the trade balance coming out. For initial jobless claims, the previous reading was 227,000, and we're watching to see if we hold near those levels or if there's any deterioration in the labor market. The trade balance previously came in at negative $56.8 billion, and we're looking for any signs of improvement there as trade dynamics continue to shift. Looking ahead to tomorrow, Friday the 20th, we have some major releases that could really move markets. GDP is scheduled with a forecast of 3%, down from the previous 4.4%. That would represent a meaningful deceleration in economic growth if it comes in as expected. We're also getting the Personal Consumption Expenditures Price Index, which is the Fed's preferred inflation gauge, with a forecast of 0.3% versus the previous 0.2%. That uptick would signal inflation is still sticky. Consumer Confidence Index is expected at 57.3, up slightly from 56.4, and the University of Michigan Consumer Sentiment is also forecasted at 57.3, matching the previous 57.3 from earlier this month. Tomorrow's data dump is going to be critical for understanding whether the economy is achieving the soft landing the Fed is hoping for, or if we're seeing more concerning signs of slowdown paired with persistent inflation.
That's a heavy day-to-day tomorrow that could really set the tone for the rest of the month. Lizzie, let's shift to our stock of the day. We're looking at BrightSpring Health Services, ticker BTSG. What's your take on this name?
BrightSpring is a really interesting case study in momentum versus valuation right now, Robert. This is a home and community-based healthcare services platform operating through two segments, pharmacy solutions and provider services. They deliver clinical care, including infused, injectable, and oral medications, primarily to Medicare and Medicaid populations in home settings. The stock has had an absolutely remarkable run, up nearly 97% over the past year, climbing from a 52-week low of 1548 all the way to 4115, where it's trading now, which is 99.4% of its 52-week high of 4140. Year to date, it's up another 7.16%. The company is riding several secular tailwinds. The demographics favour ageing in place. There's a structural shift away from institutional care toward home-based services. And the cost-effectiveness of home healthcare versus hospital settings makes it attractive to payers. Those are all legitimate long-term drivers. However, and this is a big however, the valuation has gotten stretched. We're looking at a trailing P/E of 76.20. Which is exceptionally high for a healthcare services company. The forward P/E is 30.83, which implies analysts expect earnings to more than double, but even at 30 times forward earnings, you're paying a premium multiple. The price to book is 4.68, nearly 5 times book value. 15 analysts cover the stock with a consensus target price of 44.47, which gives you only about 8% upside from current levels.
8% upside with a 76p/E, that's a pretty asymmetric risk-reward profile. What about their recent earnings and what are we expecting going forward?
That's exactly the concern. The forward P/E compression from 76 to 31 tells us the market is pricing in significant earnings acceleration, which means there's no room for error. If they miss on earnings or guide conservatively, you could see a sharp correction because momentum stocks with high multiples get punished quickly when the narrative breaks. The company needs to execute flawlessly to justify these levels. Looking at the year-end outlook, analysts are projecting that 44.47 target, but given we're already at 41.15, the risk-reward is skewed to the downside. You've got maybe 8% upside to target versus potentially 40 to 50% downside if the stock reverts to a more normalized valuation in the mid-20s P/E range, which would put you back in the $32 to $35 area. The main banks covering the stock seem to acknowledge the strong fundamentals and growth trajectory, but even they're not projecting massive upside from here. Recent analysis from Yahoo Finance is questioning whether the current price reflects long-term cash flow potential after this 78% rally, which suggests even the bulls are getting cautious. The key risks are valuation risk, which is primary, momentum reversal after such a strong run, regulatory risk given the heavy Medicare and Medicaid exposure, and execution risk because high multiple stocks have zero margin for operational missteps. On the opportunity side, if they can accelerate earnings growth beyond expectations, there's potential for multiple expansion, and as a platform business, they could see meaningful margin expansion through operational leverage. There's also M&A potential in the healthcare services consolidation wave.
So what's the verdict? Is this a buy-the-dip opportunity or are we looking at a name that's gotten ahead of itself?
I'd say wait for a better entry point. This is not a buy-the-dip situation because we're not in a dip, we're at all-time highs. The stock is trading at 99% of its 52-week high with an 8% upside to analyst targets and a 76 trailing P/E. That's an unfavourable risk-reward setup. For new investors, I'd recommend waiting for a pullback to the $32 to $35 range, which would give you a forward P/E in the 24 to 26 range and a much better entry point. For current shareholders who've enjoyed this 97% run, this is a good time to consider taking some profits or at minimum trimming positions. You don't want to be greedy when you're sitting on gains like that and the valuation has gotten this extended. The business quality is solid and the long-term story is intact, but timing matters. And right now the timing favours caution. If we get a broader market pullback, or if they report earnings that are good but not great, you could see a quick 15 to 20% correction that would offer a much more attractive entry point for building a position.
That's a measured approach that makes sense given where we are in the valuation cycle. Let's move to crypto. Lizzie, what are you seeing in the digital asset space heading into next week?
The crypto market is in a cautious phase right now, Robert. Bitcoin is showing a bearish sentiment overall. We're seeing significant outflows from Bitcoin ETFs, with $133 million in outflows, as sentiment remains in extreme fear territory. Bitcoin's price action is nearing what analysts are calling a turning point, with consolidation around current levels and $70,000 coming into focus as a key resistance level. The interesting dynamic is that Treasury bills are being identified as a primary driver of Bitcoin's price, which tells you macro conditions and interest rates are still dominating the narrative. There was some positive news with a hacker returning $21 million in Bitcoin stolen from South Korean authorities, and Ledden raised $188 million in the first Bitcoin-backed loan securitization, which shows institutional infrastructure is still being built out. But the near-term price direction is neutral to bearish. Traders appear panicked, and while there might be some upside towards 70k, the overall sentiment suggests Bitcoin could face downward pressure. On the institutional side, we're seeing mixed signals. Goldman Sachs CEO David Solomon revealed he owns very little Bitcoin, which isn't exactly a ringing endorsement from traditional finance. However, the UAE has been building a $700 million Bitcoin stockpile through mining with $344 million in unrealized profits, so you've got nation-states still accumulating.
What about Ethereum and Solana? Are they following Bitcoin's lead or showing any divergence?
Ethereum is looking bearish as well. The Ethereum Foundation just listed quantum readiness and gas limits as 2026 priorities, which is important for long-term development, but doesn't provide near-term price catalysts. More concerning is the technical setup. Ether is showing a bear pennant pattern that some analysts say could target $1,100, which would be a significant drop from current levels. We've seen massive outflows from altcoins over the last 13 months, with $209 billion exiting as traders potentially rotated into Bitcoin. Ethereum's staking just hit 50% on paper, but the active stake is only around 31%, which raised some backlash over misleading supply data. The Ethereum ecosystem is still innovating, with projects like Zora moving to Solana and Base Network planning to ditch optimism for a unified solution. But price action is bearish. Solana is showing a neutral to bearish outlook. Futures data shows panicked bulls with negative funding rates, which is a warning sign. The price could potentially slide toward $50, though some on-chain data hints we might be near a bottom. The $80 level is critical support. If that holds, we could see stabilization. But if it breaks, $50 comes into play quickly. On the positive side, Solana continues to attract projects, with Zora's recent move to the network being a vote of confidence in the ecosystem. Interestingly, Solana ETFs are bucking the outflow trend, while Bitcoin, Ether, and XRP ETFs are all bleeding. So there's some relative strength in institutional interest for Solana, even as retail sentiment weakens. Overall, for next week, I'd be cautious across the board. Bitcoin needs to hold current levels and break through 70,000 with conviction to shift the narrative. Ethereum needs to stabilize and show it can hold above key support levels. Solana's $80 support is critical. The macro environment with interest rates and risk sentiment is still the dominant force. And until we see crypto decouple from those factors or get some major positive catalyst, the path of least resistance is sideways to down for most major tokens.
That's a comprehensive look at where we stand in crypto. Well, that wraps up today's Morning Bell. We covered a lot of ground, from oil markets hitting 6-month highs and mixed retail signals to tomorrow's critical economic data releases, including GDP and PCE, BrightSpring's valuation concerns despite strong fundamentals, and the cautious crypto landscape heading into next week. Remember, do your own research and consult with financial advisors before making investment decisions. The markets are complex, and what we discuss here is for informational purposes, not personalized advice. If you found today's discussion valuable, please subscribe to the Morning Bell wherever you get your podcasts so you don't miss our daily market insights. Thanks for listening, and we'll see you tomorrow with another edition of the Morning Bell.